What is money? Throughout history, man has used money of one form or another as a tool for living. Shells, beads, even peppercorns have been used to pay for goods and services. After all, how far have things really come? Today, we use colored pieces of paper. The fact is, we use money simply to provide us with our individual needs of life, food, clothing, and shelter, as well as the luxuries, whatever form they might take. Money is energy. Through money, you convert the value of one day's work into so many meals or so many pairs of shoes. Money also can be used as a future claim on the things you want out of life. This money works for your financial goals. Are you using your money as effectively as you would like? Do you have a plan, taking into consideration your long-range goals? Have you thought about the possibility of inflation? Have you made insurance provisions for unexpected events? Have you looked into investments? Let's analyze some of the alternatives open to you. As you better understand the world of money, your money can begin to do more of what you want it to do. The purpose of this program is to place in context the benefits that can be derived from the effective use of money through investments to improve your life. The stock market. What does it do? First of all, the stock market is not the operation of a single place where buyers and sellers meet. Stock exchanges are places where buyers and sellers come together to transact their business of buying and selling shares in corporations in a regulated manner. Americans have been investing in our economy since the 1790s. From that beginning, the investment industry has expanded in direct proportion to U.S. industrial and commercial growth today. How many different exchanges are there that trade stocks? And what are their major functions?
There are 16 major exchanges in the United States. Outside of the United States, there are many spread from the island of Bermuda to Denmark, Ireland, Australia, and many other countries too numerous to mention. There is no known number assigned to the number of exchanges throughout the world. The largest and best-known exchange is located in the city of New York and is known as the New York Stock Exchange. Its principal function is to bring buyers and sellers together in an orderly fashion wherein the transaction is published and known to the public simultaneously.
What do they do?
The stock exchanges assist corporations in raising capital. They allow corporations to set a price on their various forms of capital instruments. Basically, they bring buyers and sellers together. However, this is not the only method in which buyers and sellers can be brought together.
Why are stocks listed on one exchange rather than another?
The various exchanges have different listing requirements.
And what are listing requirements?
Listing requirements are the criteria set up by the exchange posing certain restrictions on a corporation as to size, market value of securities outstanding, and number of holders in 100-lot forms. Remember, the exchange is interested in an orderly market and is very much concerned regarding the number of shares held by the public. For instance, the listing requirements for the New York Stock Exchange are as follows. 1, have at least 1 million shares in public hands. 2, a market value of 16 million or more. 3, 2,000 shareholders. 4, net tangible assets of 16 million. And 5, 2.5 million of pre-tax earnings for the previous year. If a company cannot meet these stringent requirements, it usually lists on a regional stock exchange where the requirements are scaled to a lesser degree. The most famous regional exchange is the American Stock Exchange. Frequently, companies go through the initial phase of public ownership on one of these exchanges, and when they meet the listing requirements of the New York Stock Exchange, they move over to the NYSE. The NYSE is a premier stock exchange and has over 1,500 companies listed.
What is the difference between the over-the-counter market and a listed exchange?
I believe I have covered, with the time permitting, the functions of the listed exchange. At the outset, let me explain that the over-the-counter market is not a physical location designated to any geographical area of the country. It is where buyers and sellers get together via telephone connection to trade in securities of very small companies. There are 4,000 companies with shares listed in the over-the-counter market that trade daily. The prices of these transactions are listed in sheets known as pink sheets, published by the National Quotation Bureau. In addition, there is a National Association of Security Dealers quote system. Over 350 members of the NASD make up the day-to-day over-the-counter market. When companies originally go public or whose securities are held by the general public, The first trading usually occurs in the over-the-counter market.
When I am buying a share of stock, what exactly am I buying?
You are buying a proportional share of ownership in the company, wherein you share with other stockholders in the gains and losses and earnings of the company. You are simply an owner, and as an owner, you have the rights and responsibilities to see that your company is effectively managed.
How long does it take to get delivery of a share of stock?
This is not a question that can be answered with any degree of certitude. It depends on how active the markets are. We have gone through a period wherein the volume on the New York Stock Exchange has exceeded 30 million shares daily for a reasonable period of time. Then the transfer of securities becomes delayed. Under normal conditions, between 2 and 3 weeks after date of purchase and proper payment, you should be receiving your certificate.
Do I have to hold on to that certificate myself?
You don't have to hold on to your share of stock. However, many people wish to have their ownership registered in their name in order that they may receive the dividends. Others will leave the securities in the name of their broker in order that the dividends may be collected and credited to the account at the brokerage house. You can also open a custody account with a bank wherein the stock will be held at the bank in the name of the bank nominee, and the dividends will be credited to your account there.
Why can't I buy a stock directly from a company?
Because when a company issues stock, it is issuing proportionate ownership in the corporation, and legal papers have to be filed in the form of a registration prospectus to inform all potential investors of the financial reports of the company. You can buy stock from a company when they are going through a registered public offering, or as commonly known, going public, but normally you would buy shares of stock from another holder.
What is the cost of doing business?
A rough rule of thumb is that a purchase and sale will cost in the neighborhood of 1 1/2% of the total market value involved. In other words, if you purchased $10,000 worth of securities in one company, your commission cost would be approximately $150 on the purchase, and likewise $150 when you sold the securities, assuming the price level hadn't changed.
Is there any type of protection or insurance on a stock certificate?
Under Congressional Act, the Securities Investors Protection Corporation was formed. It is a government agency which protects holdings in your account. However, many firms have provided additional insurance.
Ask not what you can do for your brokerage firm, but what your brokerage firm can do for you. Let's say I'm a potential investor with no experience in the market. What can I expect if I walk into a brokerage office?
For openers, you'll probably be introduced to a registered representative, commonly called an account executive or stockbroker, who will inquire as to the type of financial service or information you need. He'll want to discuss your financial objectives and exactly what you're looking for. From there, it is more or less up to you to let him know what you want to do.
Can I just walk into a brokerage office and ask for information on the services they have to offer?
Absolutely. You could be asking for information on a specific security or general information on bonds or mutual funds or tax shelters. They should be equipped and ready to help you in these areas without your doing any business. But if you want a more complete idea of what you'd be doing in the market, you've got to sit down with an account executive and discuss your financial objectives as you define them and as he will define them for you.
Now, if I want to open an account, what are the procedures?
The account executive will fill out a form for you. He'll ask you questions for what we call an account information card. This is a very limited financial history. He will ask your name and address, social security number, which is required by law, the name of your bank. They'll need that as a credit reference. If you've previously had a brokerage account anywhere, which broker you had for a credit reference. He'll ask you if you're employed, and if so, by whom and in what position. Basically, that's about it.
I've always been afraid to go into a brokerage office because I really don't have that much money to invest. Would a firm bother with, say, a few $1,000s?
Most brokerage firms are interested in opening accounts of all sizes. I think you'll find that the response you get from whatever branch office you walk into will probably be surprisingly favorable.
After I sign the account form, how soon can I actually start buying or selling?
That depends on the size of the transaction. If it's a small transaction, you can probably do it that day. If it's a large transaction, they may require a deposit from you. If you're prepared to give it to them that day, you could start trading the day you walk into the office.
And what can I expect from my broker after I begin doing business?
Again, it depends on the type of investment you're making. If you're buying a municipal bond or a very long-term investment that doesn't have to be touched, you shouldn't expect him to call you every day, since there's really nothing for him to call you about. On the other hand, if you're going into a transaction where you're buying speculative securities, then he should keep in touch with you regularly, because you're going to be very sensitive to what is going on in the market.
Are there different types of accounts that can be opened?
There are three basic types of accounts. You can open a single account in your name. If married, you can open an account as joint tenants with rights of survivorship, where both parties share equally in the account, and if one is deceased, the entire account goes to the second party. Or you can open an account as tenants in common, which might be you and a relative, or perhaps a friend who is not related. As tenants in common, each of you has an equal half share in the account, and at all times that share is kept separate. These are the three basic types of accounts. Of course, there are more complicated accounts: corporation accounts, trust accounts, custodian accounts. But as far as individuals, these are the three basic types of accounts.
How soon after I purchase securities would I receive a confirmation of that transaction?
Normally, within 2 days, you'll get a confirmation which will completely spell out the nature of the transaction, whether you bought or sold, how many shares, the name of the stock, the price at which you purchased or sold it, and the total amount. If you haven't received it by the third or fourth day, call, because these transactions are supposed to be settled within 5 business days and under normal circumstances always are. By the way, if you buy a stock on a Friday, you're supposed to pay for it by the following Friday. If you sell a stock on a Friday and deliver it in good form, the check should be sent out to you by the next Friday.
My account executive can't do anything without my approval. Is that correct?
That's correct, unless you give him discretionary power.
And discretionary power means what?
It means that you are giving him the right to buy and sell for your account without your telling him to do so beforehand.
Is this a standard practice?
It's a practice used by some people who are relatively tough to get a hold of, but in general it is not something I'd recommend for most investors.
Are there any other records I'll be receiving?
Yes, you'll receive a statement at the end of any month in which there is a transaction in your account. A transaction means not just a buy or sell, but a dividend receipt or any movement of monies or securities in the account. If you do not have any transactions for several months, you'll still receive a statement showing you what's in your account. You receive a minimum of 4 a year. This varies from firm to firm, but most of them follow this procedure.
Can I use this statement for my tax records?
Both statements and confirmations can be used for your tax records. And at the end of the year, you'll get, on the final statement for the year in December, a record of any dividends received in the account.
I understand some people buy stocks on credit. Is this referred to as a margin account?
A margin account means that you will not put up 100% of the cost. At the present time, current requirements of the U.S. Federal Reserve are 50%. So if you buy $5,000 worth of stock, you put up $2,500. You must have a minimum of $2,000 equity. A brokerage firm charges you interest on the borrowed part of the purchase. At the end of the year, the statement showing dividends received will also show what interest has been charged to your account, which may be used as a tax deduction.
If I open a margin account, are there any special papers I have to sign?
Yes, it's called a marginal note agreement. Basically, this is your credit agreement with the brokerage firm, allowing them to take certain steps if you do not meet the margin requirements that the U.S. Federal Reserve requires. It's nothing to be afraid of. This is only a statement saying that they are lending you money, and in return for this are holding your securities as collateral. And if you do not meet the margin requirements, meaning if you do not put up the 50% of the purchase, then they can sell sufficient securities to get that money back.
Let's say the price of my stock has dropped, and I have a margin account. Is there a certain amount of time I'm allowed to send in that additional money?
Yes, you're allowed a reasonable amount of time to get the money in. In the first place, your stock would have to fall quite a bit. You don't get a margin call the first day your stocks fall. What normally would happen is that you would first get what we call a house call, which is not a maintenance call, but a call from the brokerage firm, right above the maintenance level, to give you some more time. In that case, you'd normally have about a week to get the money in. If you go right to a maintenance call, which is a lower call, you would normally have 2 days to get the money in. I think if there is a delay for reasonable reasons, there is not going to be a big problem.
Would this margin call come to me by telephone?
It comes to you either by letter or by telegram, but normally your account executive should call you in case the mails are slow to let you know. 90% of the time he will do so, and you will have ample time to get the money in.
Are brokers better in offices in major cities?
With swift, sophisticated communications, any broker in any branch is just seconds away from the main information bank. It doesn't matter where you go to a brokerage office. The difference in service is in the individual broker rather than in the geographic location in which he resides. Executions of orders are just as good from Hawaii as they are from downtown New York City.
If I should become unhappy with my account executive, what can I do?
Just go to the branch manager and tell him you are unhappy and that you want to be switched to another. It's no problem at all. If, however, a problem should arise, in every case the person to go to is the branch manager. If the branch manager doesn't give you satisfaction, then you should go to one of the regional offices, either the main office or the main regional office of the firm, depending on what part of the country you're in.
Someone once told me that a broker and his customer are basically in a conflict of interest situation, because all that the broker wants is to make his commission.
The broker and his client have mutual interests in mind, and that is for the client to make money. Because if the client makes money, his account gets larger, and the broker can make more money on a larger account than a smaller account. Number two, the client will then tend to refer other people to the broker. Most of the growth in the brokerage business comes from opening accounts on the basis of referrals. So it behooves the broker to do the best job possible for his client. Most of them realize this.
We sometimes hear people say they've never made money in the stock market. This is probably true for many, but there's generally a very good reason. Most people don't take a professional approach to help them better manage their money. Just as you used professionals in other aspects of your life, doctors, lawyers, bankers, a money professional is more likely to give you better results than someone without the necessary training and experience. How do you find him?
Finding a good broker is hard. There are really one of three ways to do well in investing. The first is to make all decisions yourself, to decide personally what you should buy, what you should sell. The second is to let someone else do it for you in total, to give them your power of attorney, to let them decide what your portfolio should be like, with you simply providing the capital for them to work with. The third way is for you to work closely, in partnership really, with a broker, not making all the decisions yourself, nor letting him make all of them, but really to work in tandem with an account executive to try to do better with your money than either one of you might do alone. The question then is, how do you find someone who will work well with you? It may seem difficult, but it's actually very easy to select a broker, or account executive as they're called today, to help you achieve optimum investment results. It requires some work, but it's quite a doable function. To begin with, you don't have to be a genius to be a good broker. You don't have to be a good broker to be a successful investor. Many people pursue the traditional method, simply talking to a friend, a relative, or a business associate to get the name of a stockbroker. They hope in that way to find someone who has apparently serviced another at least satisfactorily. I think that's a mistake. Others of us simply walk into a brokerage office and are normally assigned to an individual who is the so-called man or woman of the day. This is a broker to whom all incoming, undirected traffic is sent. That, too, I think, is a mistake. It's simply a random selection method and has nothing in particular to recommend it. A third group of investors deal with people who have solicited or contacted them directly. The shortcomings in this method are obvious. Indeed, I really think all three of these normal ways of finding a stockbroker are quite poor. If I were setting out to find an account executive, first and foremost, I'd sit down and try to map out exactly what I hope to achieve with my investment program. Do I want to conserve the money I have now, to take risks in hope of making my capital grow over the short term? Do I want long-term capital gains, or do I have special tax problems? Do I need retirement security, income now, or some combination of these? All of these relatively basic questions can give you an idea of your needs, and you can, after that, go about selecting a broker in a fairly scientific fashion. To begin with, do some background work in your local library on 4 or 5 companies about which you know a little bit. Find out what they earned, what businesses they're in, and study some of their key financial information. This type of data is readily available in the Moody's and Standard & Poor's corporate guides that are a part of the directory assistance available in almost any community's public library. I'd write to those companies for copies of their latest annual and quarterly reports. There's no charge for this information. Corporations indeed are delighted to provide them to you. Do some background reading in Forbes, or read the investment columns of Business Week, Fortune, or Barron's magazine. Armed with just this bit of basic material and any other particular questions you might have in mind, go into first one, and then a second, and then a third local brokerage office. I would ask to speak with the branch manager, tell him I was interested in opening an investment account. I'd explain that I was interviewing to find a broker who's the right person for me. I'd then outline to the branch manager what my particular basic investment goals and objectives are. Most managers of New York Stock Exchange member firms will do a good and impartial job of trying to fit client to broker, particularly when you tell them that you are going to be talking not only to individuals at their firm, but also to people with their competitors. What you really want to assess is the chemical interplay between yourself and the potential broker. Follow your intuition. It's apt to lead you well. But don't, however, leave it all just to chemistry and intuition. There are some very charming people who don't make good brokers for one type of person or another. Hence, I would use the innocent entrapment basis of selection. I'd ask a broker what he thought about one of the 4 or 5 companies I'd previously studied, and then I'd listen carefully. If the broker's a hip shooter, if he or she is inclined to give you information which may not be backed up by fact, then quickly turn and look for someone else. If a broker says, well, I don't follow that company, or I don't know that particular bit of information, but I'll find out for you, I'd score that as a tentative plus. But then I'd wait and see what sort of information he got for me, how detailed, how accurate, and how quickly he obtained it. Given high marks in those areas, I would say that the broker who admits he doesn't know everything right off the bat is probably better than the one who doesn't. Next, ask a few leading questions about this small group of companies where you've pre-armed yourself. Try, if possible, to include 1 or 2 suggestions about securities which simply would not be suitable investments for you. If, for example, you are a conservative long-term investor and you mentioned the shares of a low-priced speculative electronics issue, the broker replied, yes, that's something you ought to buy, then you might question whether he's just looking for his commission income rather than looking out for your best interests. Remember, don't choose the first person you talk to. Don't go to just one firm. Talk to a broker or 2 at each of several firms so that you can compare and contrast before you make a decision. Importantly, when you finally do select a broker, make it first on the basis of somebody you feel comfortable with, who you feel is truly in tune to your needs. Select someone you can understand well and clearly. Don't be buffaloed by the jargon of the investment business. Every profession develops its own complicated language to hide how simple the basics really are. Don't be afraid to ask the broker, what does that mean? Can you put it in simple, clear-cut terms? There's nothing in investment that can't be understood by the intelligent layman rather quickly. Again, after that, trust your intuition. It is really not as much what a broker says as the shade of meaning behind it which is important. And here, the housewife, businessman, or student can be just as good an evaluator as someone whose everyday business is nothing but the assessment of various investment opportunities. Keep in mind that you're the one doing the interviewing. You're the person in charge. You're assessing the accuracy, honesty, depth, and interpretative capabilities of the broker. Finally, once you've selected someone, try to work with him or her in a harmonious fashion. Many investors tend to take credit for the good investment decisions as being their own wisdom, and heap the blame for poor results on their brokers. This is a psychological mistake. Also, don't fall into the pitfall of following the broker's advice blindly. In most cases, this is a mistake too. Be supportive of your broker in his role as a financial counselor. If you do that, you'll find that the advice you get will more often than not be timely and geared entirely to your personal needs. This should help you perform well, and certainly better than otherwise, in the many marketplaces of investment today.
As an investor, you will find yourself becoming more and more interested in keeping current on national and international business and economic news. Your daily newspapers and business magazines can provide a general picture of day-to-day events, as well as useful analysis of what it all means.
When people are investing, it's prudent from their own point of view to be informed about what is going on, not only in the stock markets and money markets, but also on the national and international business and economic scenes. A lot of this information can be obtained just by reading the daily newspapers. Another excellent source of information is your securities broker. This man knows what your financial picture looks like and what your objectives are. Once a person has become interested in the whole world of investments, one good way to educate himself and be current is to read the Wall Street Journal. Also, this is the must-reading for every account executive across the nation. Other leading publications which are widely read by investors include Barron's, which is a business newspaper published weekly, and business magazines such as Businessweek, Forbes, and Fortune. These provide more in-depth feature articles on industries and companies. General news magazines like Newsweek, Time, and U.S. News and World Report are also excellent sources for keeping in touch with the world. Money magazine is devoted to money matters of interest and common concern. A full-service investment firm should have professionals on staff who are constantly studying, appraising, and evaluating not only companies but also the industries they represent. In other cases, investors may ask for research reports on companies that are of interest to them. A full-service brokerage firm would also have access to many other independent research services such as Standard & Poor's. If a person becomes interested in a company and would like to know more about the history of that company, he can request a Standard & Poor's sheet from the broker. An S&P sheet is simply an easy-to-read synopsis of the company's business activities. It is not an in-depth report. There are many other financial reference services, and working with a broker who has access to a wide range of information will simplify an investor's task. Becoming informed begins the day that an investor becomes interested and involved, for the information is always available.
How's the market doing today? A question that's echoed around the world by every investor, whether he owns a single share or has an extensive portfolio. There are all kinds of barometers to judge market performance. The most familiar is the Dow Jones Index. But what is it?
There are probably dozens of indices. Most well known is the Dow Jones Industrial Average. This consists of 30 stocks, 30 of the biggest and best known companies, such as American Telephone, General Motors, U.S. Steel, and General Electric. There are two other Dow Jones averages. That's a Dow Jones Utility Average, which is comprised primarily of electric utility companies, and there is a Dow Jones Transportation Average, which includes railroads and airlines, etc. But the average that most people talk about is the Dow Jones Industrial Average, which is, as I said, comprised of 30 major companies not in banking, not in the electric utilities business, and not in the transportation industry. There is one exception. American Telephone is included in the Dow Jones Industrial Average, although it is technically an electric utility. The price of these stocks are added up and averaged, giving you the Dow Jones Industrial Average. And when you hear that the industrial average went up 8 points one day or down 6 points another day, this means that the average of these stocks went up or down.
Are there other yardsticks to measure stock market activity?
There is the Standard & Poor's averages, also known as the S&P 425 and the S&P 500. The S&P 425 consists of 425 industrials, comparable to the Dow Jones 30 industrials, and the advantage of this is that there are more companies. The index is also calculated in a somewhat different way statistically. The S&P 500 includes the S&P 425, but also utility stocks and transportation stocks. Despite the fact that you have 425 stocks in the S&P averages and only 30 in the Dow Jones Industrials, they move pretty much in tandem. Sometimes they are slightly different, but over an extended period of time they tend to move together. There are other averages as well that include a lot of the secondary, more speculative companies. But the average that most people talk about when they say, "What's the market doing?" generally refers to Dow Jones. And you can generally get that on the radio and television and in the daily newspapers.
Speaking of newspapers, how do you read the stock tables that appear in most dailies?
You can have the name of the stock and then several columns of numbers. The way the Wall Street Journal lists it, which is pretty similar to the way everybody lists it, the first two columns of the listings will give you the stock's high and low prices for the year. Right next to that, you have the name of the company, and next to that, you get the dividend rate that the company is paying per year. After the dividend rate, you get a number which indicates what the stock's price-earnings ratio is. The next column tells you how much stock in number of shares was traded the previous day. The following three columns give you the high price, the low price, and the last price at which the stock traded on that previous day. The final column is the change in price from one day to the next.
Now can you explain what these numbers mean?
Stocks trade in variations of 1/8 of a point. A point is $1. An eighth of a point is 12.5 cents. A quarter is 25 cents, and so on. I don't know why they do it in eighths of a point. I think it would be a lot easier if they did it in tenths of a point, but it has always been in eighths of a point. You'll find it easy to pick up if you choose, say, one or two stocks and begin reading about them on a daily basis. That's one of the best ways I can think of to learn about the market, being interested.
When you buy a share of stock in a company, you are buying an interest in business. You should, of course, be concerned whether you are getting assets equal to, less than, or more than what you are paying. You might ask, am I buying interest in a company which is generating profits and will ultimately pay dividends to me as partial owner? Am I getting fair value for my money? How can I begin to answer these questions?
The two principal financial statements that you look at are the balance sheet and the income statement. When you look at a balance sheet or income statement, you are simply trying to learn whether the price that you are paying for the stock is a fair valuation of your proportionate interest in that company. The balance sheet is like a snapshot, a picture of the company at a single point in time from a financial standpoint. At this one instance in time, usually at the end of the fiscal year, the balance sheet will give you an indication of whether the company owns a great deal or has a lot of assets, and the degree to which these are offset by liabilities. The difference between what the company owns and what it owes is what you have. This is the tangible figure of what a company's book value is, and your percentage of that is what your stockholders' interest is.
How do we know the company's report is true?
The report is prepared internally by the corporation and then audited by outside auditors who attest that it is consistent with generally accepted accounting practices. But so much for the balance sheet for the moment. The other key term we're dealing with is an income statement. I refer to the balance sheet as a snapshot. An income statement is more like a motion picture. It tells you on a continuing basis how the company is doing. The income statement will tell you for a period of time of 3 months or 6 months or a year how much a company earned and how they earned it. The income statement comes down to that bottom line figure, the company's profits, and that's what you, the investor, are really interested in because it is out of the profit that the company will pay dividends to its stockholders. It's also those profits that generate the capital for expansion.
How can I determine how much the stock's worth?
The fact that a company is doing very well doesn't mean that it is worth an infinite amount of money. Also, if a company is doing poorly, it doesn't mean that it is worthless. There is a price and value attached to everything. So the next step is to say, based upon the company's total assets and earnings, we as investors estimate that this company is worth $10 million, or $50 million, or $100 million, or whatever. We can divide that total value by the total number of shares of stock outstanding, so that if, for example, this company in our judgment is worth $10 million and that there are 1 million shares outstanding, then the value of one share would be $10. Thus, if a company can earn $1 million this year and there are 1 million shares outstanding, then we say that the company has earnings of $1 per share. Now the question is, what are earnings of $1 per share worth? Well, for companies that are growing very rapidly, a dollar of earnings today may be worth quite a bit since we expect future earnings to be higher.
What this amounts to is that the investor tries to anticipate whether the earnings are going to grow fast and more dividends are going to be paid out.
That's correct, and in that case he is willing to pay more. If he thinks that he has a mature, deteriorating industry, he wants to pay less. In general, this is the explanation as to why growth companies like IBM sell at very high prices relative to their current earnings, where other very finely managed companies like U.S. Steel, for example, might sell at lower prices relative to their earning power. The investors expect that IBM's earnings will be increasing rapidly over the years, whereas U.S. Steel's might be more stable over the years, or perhaps more cyclical, which means simply that profits will go up and down with the economy.
In light of all this, how would you define a growth stock?
When we talk about a growth stock, we mean a company whose earnings, on an average, are expected to grow at a rate faster than that of the whole economy, and to some degree independent of the economy, because it is manufacturing a product that its customers are going to buy year in and year out, regardless of their own personal financial situation.
There are so many terms you use in analysis of stocks. What are some of the most common?
One of the most common terms used is the price-earnings ratio, also called the price-earnings multiple. That's really very simple. This is the price of the stock divided by the earnings per share. As I mentioned, the earnings per share is simply the company's total earnings divided by the number of shares outstanding. The price-earnings ratio might be 6.5 times, or 10 times, or 15 or 20 times.
What are some other considerations?
He wants a well-managed company, a rapidly growing company, and a company paying high dividends generally. And since other investors recognize these same things, they tend to bid up or pay higher prices for the shares of better managed, more rapidly growing companies. That is why the price-earnings multiple will tend to be higher on rapidly growing companies than for slower growing companies.
You mentioned earlier a company's dividends.
That's right. A dividend is the amount of money that the company pays out to its stockholders out of its profits. When you divide the dividend that the company is paying by the price of the stock, you get what is called a dividend yield. The investor can compare that dividend yield to the kind of return that he might receive if he left his money in a savings account, for instance.
Is a dividend like an interest payment?
Not exactly, in that there is no obligation or contract on the part of the company to pay the stockholder dividends. The dividends are the tangible portion of the profits that the company has earned.
How does a company decide on whether or not to pay dividends?
The board of directors of the company decides what the company's dividend policy will be and what the dividend will be each quarter. Most companies that pay dividends pay them on a quarterly basis or every 3 months. Companies that are growing over time frequently have records of dividend increases. As their profits increase, the dividend share will increase. When some companies have particularly good years, they pay a dividend extra at year-end, kind of like a Christmas present to the stockholders in December. Of course, sometimes it works the other way around. Companies that have had a bad year have to cut their dividends or will stop paying them entirely for some period of time.
Do all good companies pay dividends to investors?
There's some very fine companies that choose not to pay dividends at all, or to pay small dividends, primarily because, in the opinion of management, reinvesting those profits in their own operations, expanding their business, will in the long run be more beneficial to the stockholders than paying out dividends directly.
Another term I see frequently is book value per share.
This is a total dollar figure, which is again divided by shares outstanding. The balance sheet tells you the difference in what a company owns and owes. The difference is called the company's net worth. To obtain the book value per share, divide the net worth by the number of shares outstanding. So if you have a company whose assets are $15 million and it owes in the form of bank loans and debts $10 million, the difference is $5 million, and that is their net worth. If they have 1 million shares outstanding, that means they have a book value of $5 per share.
Where can I find all these numbers?
Some of the numbers are calculated by analysts and investors. Sometimes the company gives it to you. Some of the numbers are picked up and reported in financial newspapers or magazines. In general, companies issue an annual report which explains what happened to the company during the previous year. Security analysts on Wall Street get these reports, talk to the companies, and write their own reports, which are generally made available by brokerage firms to their clients. These go into greater detail on what the information means.
How do brokerage firms judge the performance of one company versus other companies in the same industry?
Most full-service firms have an investment research department that follows virtually all major companies. The analyst who, for example, follows the oil companies knows that one oil company may be selling at a lower multiple or higher dividend yield than another, and therefore looks more attractive. And there is also the awareness on a fundamental basis as to which companies are doing what and where. The analyst combines his own judgment as to the quality of the company with knowledge as to what is going on and what it may mean to the future to determine where the greatest potential lies.
Up until now, we have talked about the fundamental approach to stock selection, but there is another approach that many professionals take to assist them in making decisions. This is called the technical approach.
The technical approach to the market says that people are meeting on the floor of the stock exchanges every day to exchange securities. The price action in the stocks reflects the judgments of a lot of smart people. All of the information that they talk about becomes reflected in stock prices. So the technical analyst tries to interpret the way the stock is moving. He looks at patterns, chart patterns. By this I mean trends in the way a stock is trading from one day to the next. He tries to discern from these patterns what is going on with a company. The idea is really quite simple. A stock is going up if more people want to buy it than sell it, and it's going down if more people want to sell it than want to buy it at a given time.
The technician records all this on a chart, doesn't he?
Yes, he keeps all kinds of charts, those that indicate the patterns in which prices move, both in terms of price changes and in volume. It is more significant to him if a stock is going down on high volume than if it's going down on low volume. When it is going down on high volume, that means a lot of people want to sell it. They try to find patterns in the past trading of the stock.
How does this actually work?
Let's suppose that there is a company which, over a period of several months, has traded in a very narrow range from $50 to $55 a share. Let's assume now that they have announced some very good developments, earnings have increased, or maybe there was a major corporate development, and the stock moves up very sharply to a price of $75 per share. Then assume that there is some bad news and the stock is driven lower and it goes down from $75 to $65 to $60. The technical analyst might be asked not, what do you think the stock is worth? He would be asked, where do you think the stock can decline from here based on its overall trading pattern? And it may well be, in looking back, he will say, it looks as if there was a lot of support for the stock in the area of $50 to $55. His reasoning would be that in the past there was a long period of time during which the stock traded between $50 and $55. That means that there were a lot of people looking at the stock in that area. A lot of them were thinking of buying the stock there who never did. Then they saw the stock run all the way up to $75 a share, and a number of them were probably saying to themselves, you know, I made a mistake. I should have bought it at $50 or $55. If I had bought it there, I would have made this much money now. I won't make that mistake again. If it ever gets back down there at $50 or $55, I'm going to buy it. Now they watch the stock decline from $75 to $67 to $63 to $60, and they're waiting. And if it gets down to $50 or $55, a lot of people will probably come back into the market figuring they have gotten a second chance.
Is there a term for that $50 to $55 price range?
Yes, there is. That is called the support level. It also works the other way around. Let's suppose now that the stock has gone down to $50 to $55 and it's back up to $62 to $65 a share, and now the technical analyst will be asked, how high do you think it can go? He may now come back and say, well, I don't think it's going to go much over $75 because that's a resistance area. Why is that called a resistance area? Well, remember those people who owned the stock at $75. They're kicking themselves for not selling it, and they're saying, if it ever gets back up there again, I'm going to sell it. So when it gets back up there a second time, there are a lot of people who will come into the market to sell it, and that is called a resistance on the upside.
Do technical analysts just look at price action on their charts?
The best technical analysts I know pay attention to what fundamental analysis is all about. The best fundamental analysts I know pay attention to what technical analysis is all about. Technical analysis can sometimes indicate that something is happening at a company. The technical analyst is not only concerned with movements of individual stocks. He also follows the activity of the overall market as reflected in the various market indices, such as the Dow Jones.
Some people watch life go by. Others make it happen. Our financial future is a major part of our general well-being. Have you ever asked yourself, what should I do with the money I have? What will I live on when I retire? If you have not given thought to these questions, you are likely going to be faced with financial anxiety in the future. The big question to ask is, what am I working towards? Then use your money to work for you.
Before you invest 1 cent, prepare what I like to call a master financial plan. Within that plan, the first step is a budget. Analyze your income and spending patterns. This is called a cash flow study. On the one side, list all your sources of income, including your salary, interest income, and stocks. On the other side, list what you are spending, what it costs you to live on an annual basis. Your net cash flow is the term for what is left when you subtract what you are spending from what you earn. You now know how much money you are earning, spending, and saving. Now it's time to think about your goals and how you plan over the coming years to accumulate funds to build towards these goals. A short-range goal would generally be for the coming year, possibly planning a trip or purchasing a new car. Medium-range goals of 5 years or so could include buying a house or starting your own business. Your long-range goals would be for some years from now, your children's education, your retirement.
Now am I ready to invest?
Not necessarily. Remember, investing is only the use of money to make money. To accumulate the funds to invest, most of us need to save. Before investing, it is wise to set aside adequate emergency funds. A rule of thumb is to have money equal to 2 months' income available. Of course, the sooner you start building, the sooner you can begin advancing toward your goals.
How do I choose my investments?
Investment selection can only be meaningful if it is part of an entire strategy fit to your own needs and goals. Once you know where you're going, you can choose professionals to help you work out a long-range financial strategy. You can have the fun of selecting these investments that will best achieve your goals and can be alert to situations that might change these goals. Perhaps you are single. Your short-term goals and needs will probably differ from those of a married couple, but you share many of the same uncertainties and long-range goals.
What exactly is estate planning? Where does it fit in?
Estate planning is an integral part of your long-range financial planning. An estate is simply what you leave to your beneficiaries upon your death. This is controlled greatly by your will. Have you written a will, or has your spouse? Your will should be written with the advice of your lawyer. It should reflect what you want to do with your estate. How you want to dispose of your net worth, your primary consideration should be, how can I best implement my desires and at the same time minimize estate taxes?
Does estate planning change with the different stages in my life?
Of course. Let's say you're under 40. You are probably looking to support the people you leave behind. This is a period where you are accumulating assets. Most people in their 30s or low 40s have small children, so wives are generally unable to work if the husband dies. Insurance fills much of this need.
Is insurance the core of estate planning?
When you're young and married, yes, because you generally haven't accumulated enough in any other way to take care of those you leave behind. As you get older or accumulate more assets, your mortgage gets paid off, your children grow up and are educated and on their own. Then your own expenses go down and your salary usually goes up, so your need for insurance may diminish. Your estate planning is often building a fund provided by insurance until other assets can be accumulated.
What preparation should the head of a family start making today?
It's important to establish a financial relationship between husband and wife, whether you share in the decision-making process or not. A married couple should sit down and commit to paper where they stand and should review this annually. With this information, you'll at least have a starting place. Someone often dies and their survivors don't even know where things are kept, such as bank books, checking accounts, stocks, insurance policies, mortgages, and company pension information. So make a checklist of all the financial aspects of your life. Make certain that your spouse and lawyer know exactly where the information is, how it's assembled, and what is there. This information flow should be established now. This will enable your lawyer to settle your estate with the government